Hi, I'm Franz. Today, let's talk about something that makes our money work smarter: financial intermediaries. What is financial intermediaries? A financial intermediary is an institution or individual that connects people who have money with those who need money. They act as a middleman between two parties in a financial transaction. When you deposit money in a bank, it doesn't just stay there, it gets loaned out to someone starting a business or buying a home. This process is made possible by a financial intermediary. It is the middleman between people who have money and those who need it. Banks, credit union, insurance companies, pension funds, these are all financial intermediaries. They help keep money moving in the economy. By managing risks, reducing costs, and helping people borrow or invest, intermediaries play a huge role in keeping our financial system running smoothly. They help the economy by making it easier to save and borrow and managing financial flows efficiently. So next time you deposit money or take out a loan, remember you're part of a financial system powered by intermediaries. In short, financial intermediaries keep money moving, opportunity growing, and the economy flowing.
Hey everyone, I am Alianna. Let's start with the basics. Capital markets bring together investors, people with surplus funds, and borrowers, like businesses or governments who need funding for long term projects. But most of the time, these two parties never meet directly. So, how does the money get from one to the other? That's where financial intermediaries come in. A financial intermediary is like a financial matchmaker. They channel funds from savers to borrowers, and they do much more than just pass the money along. They transform, repackage, and manage risk along the way. Let's break down three common types: banks, investment companies, and mutual funds. Let's see how each one plays its role in the capital market. First up, commercial banks. They collect deposits from individuals and businesses. That's your savings and checking accounts. Then they lend those funds out to businesses through loans or mortgages. Banks also participate directly in capital markets by buying government or corporate bonds, and some even help companies issue new stocks or bonds, acting like underwriters. Next, you have investment companies. These firms manage investment portfolio for individuals and institutions. Think of them as professional money managers. Some focus on private equity or venture capital. They invest directly in businesses, often in early stages, expecting big returns later. Others might specialize in buying and selling stocks and bonds on behalf of clients. They help allocate capital more efficiently across the economy by betting on where the best return might be. Lastly, we have mutual funds. Mutual funds take money from many small investors and pull it together to invest in a diversified portfolio of stocks, bonds, or other securities. By doing so, mutual funds play a huge role in democratizing investment and boosting liquidity in capital markets.
Hi everyone, I'm Jenny. I'm going to discuss the importance of financial intermediation for investors, companies, and economic growth. Financial intermediation plays a crucial role in the functioning of modern economies. It refers to the process by which financial institutions, such as banks, investment firms, and insurance companies, act as intermediaries between savers and borrowers. This process benefits investors, companies, and the economy as a whole in several key ways. For investors, financial intermediaries provide opportunities to invest in a diversified range of assets while reducing risk. They also offer professional management and access to information, which helps investors to make informed decisions. Intermediaries like mutual fund and pension fund pool resources from many individuals, allowing even small investors to participate in markets they couldn't access alone.
Hi everybody, I'm Sheena. As we continue our discussion about the importance of financial intermediation for investors, companies, and economic growth. For companies, financial intermediaries are essential sources of capital. Banks offer loans for business expansion, while investment banks help companies raise funds through stock or bonds issuance. This access to funding allows companies to grow, innovate, and create jobs. At the macroeconomic level, financial intermediation support economic growth by improving the allocation of resources. It channels funds from those who have excess capital to those who need it for productive investment.
Hi everyone, I'm Rosanne. I'm going to discuss the example of financial intermediary. Let's say you put 10,000 pesos into a mutual fund managed by APC Mutual Fund Company. The mutual fund manager uses your money along with other investors' money to buy. For example, the fund buys share of big companies like SM, Ayala Corporation, or Jollibee on the Philippines Stock Exchange (PSE). These shares are bought and sold through the stock exchange, which acts as a marketplace where stocks are traded. If the value of Jollibee shares increases, your mutual fund investment also grows in value. If prices fall, your investment may lose value. Over time, if the mutual fund performs well, your 10,000 pesos may grow into 11,500 pesos and you can redeem your investment through the mutual fund company.
Hi, I'm April. Let's talk about the next investment. Mark wants to grow his money, so he opened an account with a stockbroker that connects to the Philippine Stock Exchange or PSE. He decides to buy 100 shares of XYZ Corporation, a company listed on the PSE. Each share costs 50 pesos, so he spends 5,000. A few months later, the stock price rises to 70 pesos per share. Mark sells his 100 share for 7,000 pesos. He earns a 2,000 profit. Investing in financial intermediary means choosing strong, well-managed banks, insurers, or asset managers that earn steady profit, handle risk well, benefit from interest rates, follow regulation, and offer good value and diversification.
Hi everyone, I'm Lyka and I'm discussing the summary of effective versus ineffective intermediation. Let's dive in. Let's discuss about effective intermediation. Effective intermediation connects buyers and sellers efficiently, reduces costs and facilitating informed decision. It enables market participants to access products or services they need while minimizing costs and maximizing benefits. Next is ineffective intermediation. Ineffective intermediation, on the other hand, can lead to market failures, increase costs, and reduce access to products or services. It can create biases, inefficiencies, and frustration for market participants. So what we can learn from this, effective intermediation is crucial for market efficiency, while ineffective intermediation can lead to problems. By understanding the differences, we can strive for better intermediation in our markets. Remember, effective intermediation can make all the difference in the market success. Strive for efficiency, transparency, and informed decision. Avoid the pitfalls of ineffective intermediation, and you'll be on your way to better market outcomes. Thank you for watching. Hope you understand and learned something for our tutorial video. Bye everyone!